Hello guys, welcome back to this channel. Today we are going to look at forex currency pairs. So specifically in this video you are going to see main forex pairs, that is the major pairs, minor pairs and exotic pairs. I know people are used to major and minor, but they are always exotics one that are not frequently traded, and for that reason let's start. Now we have what is called a major currency pair. So these are currency pair that you mostly trade. Probably you have them in your watch list, like you can see mine here in my watch list. So basically forex trading currency pairs are classified into three main categories, and that is major pairs, minor pairs and exotic pairs. So if you understand this category, especially for beginners or intermediate one, it will help you in identifying trading opportunities and understanding the market correctly. So with that said, let's look at major currency pairs. So by definition, the major currency pairs are the most frequently traded pairs in the forex market. They usually have the USD pair as either the base currency, that is always the first currency, or the quote currency, which is always the second currency, and another major currency pair, or from another major currency of a bigger economy. Now these pairs are known for their high liquidity, lower volatility and tight spreads. They are highly popular among any type of trader because of their predictability and the stability of the economies behind these currencies. As you can see, the way I've listed them here is how I prefer trading them, in that order, but mostly I trade major currencies and others which I'll explain below. So examples of major currency pairs, specifically there are 7 major currency pairs, and that is Euro USD, USD JPY, GBP USD, USD CHF, AUD, Aussie dollar, USD CAD, NZD USD. Now what about their trading conditions for this major pair? Let's start with the liquidity. Now major pairs have high liquidity, meaning they can be bought and sold in large quantities without significantly affecting their price. Now let's look at what about volatility. Generally these major pairs have lower volatility compared to minor and exotic pairs. This implies that the price movement are more stable and less erratic. Now what about the spread? They offer very tight spreads, which are different, which are the difference between so basically spreads is the difference between the bid or the buy and ask, which is always the sell price. Now tight spreads means lower transaction cost, and you're going to realize that Euro USD has the lowest spread, followed by either AUD USD or GBP USD, depending on the broker you are dealing with. Now what about market analysis? These major pairs are often the focus of economic news and analysis, making it easier for traders to find information and make informed decisions. Especially for beginners, you are highly encouraged to operate with major currencies because of how they move swiftly. Now, so by the way, if you want to see how I analyze this pair on daily basis, you can check my Telegram channel. It's free there. So if you check it, you'll find how I do my analysis, like this trade we took yesterday of gold, and this one that we took yesterday of Euro USD. And as you can see the way they moved, so this was from where I posted the analysis. I posted that we are going to have a possible gold sell. There we go. I said here we are going to have a possible gold sell, and then I moved ahead to post if it matured, and then I posted when we were getting in, and then I posted when we are about to take profit. Same too. Then I said trail your SL. So there was also a Euro USD. I analyze very simply. I don't compromise a lot of things, so my analyses are very easy to understand. So if you want to join my Telegram. The link is in the description. Now let's check on minor currency pairs. So for the minor currency pairs, just by the definition, minor currency pairs we also call them cross currency pairs, and they consist majorly of currencies that do not include the US dollar. So they are non-US dollar pairs. These pairs are from big economies such as the Eurozone, yen, pound, and other major currencies trading against each other, and they are less liquid than major pairs but still offer significant trading opportunities. Now examples of major, this should be minor, sorry, this should be minor, typo. Example of this minor pairs, as you can see here, we have Euro GBP. As you can see, I like it here, I like to trade it. Then you have Euro JPY, I also like it. Euro JPY, GBP JPY, which is liked by many people. CHF GPI, sorry, JPY, AUD JPY, a Euro Audi, Euro CAD. Now what about the trading conditions? So in terms of liquidity, which is the first one here, minor pairs have lower liquidity than major pairs, which can lead to wider spreads and tighter transactions, and higher transactions. Now for volatility, these minor pairs tend to be more volatile than major pairs, providing significant price movement. So if you want to see erratic movement, check minor pairs, and this can create more trading opportunities, but as you know, that comes with higher risks. Now what about the spread? Minor pairs have wider spreads due to lower trading volumes, so you need to keep that in mind. So you will have a bigger spread, that means bigger stop loss. What about market analysis? While minor pairs are covered in the market analysis, they do not receive as much attention as major pairs, so it makes them slightly more challenging to find in-depth analysis. But the principle that works in major pairs also just works in minor pair if you know how to do your analysis. Now so let's check on the differences between major and minor pairs in terms of trading conditions. Now let's begin by looking at liquidity. Now major pairs are more liquid due to higher trading volumes, making them easier to trade without large price changes. Now what about minor pairs? Minor pairs have less liquidity, which can lead to slippages, especially when the price changes between the time a trade is initiated and executed, especially during out of sessions like New York, London, etc. You will find that the volumes are very low. Now what about volatility? Now major pairs usually exhibit lower volatility. What does that mean? It means that their price movement are more predictable and are less prone to sudden spikes. That is why you are always recommended to trade what? Major pairs. But what about if you want to trade minor pairs? What do you need to know? Now for minor pairs are more volatile, so it will offer you higher profit when they spike and move very fast. That means that they are highly volatile, but in return it can also pose you risk because it can take your stop loss very fast. Like let's say gold can take your stop loss very fast within no minutes, so you need to be aware of that. Now what about the differences in spread? Now major pairs have tighter spreads due to high liquidity and frequent trading, so the volume is what makes them tighter, have tighter spreads rather. But what about if you want to trade the minor? What do you need to know about spreads? Now minor pairs with lower liquidities often have wider spreads, resulting in higher cost of entering and exiting, so you can be easily tagged out before the price reaches your stop loss, or it can interfere with the level at which you said you're going to take profit. Now what about trading opportunities? Now major pairs are suitable for both generally for both beginners and experienced traders due to their stability and predictability. Now, for the minor pairs, so minor pairs offer good trading opportunities, but you will need to have a lot of skills and a bigger stop loss. Possibly, it is always recommended to trade it if you are an experienced trader, because of that high volatility and wide spreads. So be very keen of that. Now, what about market news impact? Now, major pairs are heavily influenced by economic news, and they will move like wildfire, especially from the United States as well as other major economies or countries. Now, minor pairs may be influenced by economic news from the countries of both currencies involved, sometimes making price movement less predictable. And they are also influenced by United States economy, because that is what rules most of these other currencies. Now, there is this other part which is I will not dive deep into, which is called the exotic currencies. So generally, by definition, exotic currencies pairs or currencies consist of one major, take note, one major currency paired with a currency from a smaller or an emerging economy. So unlike major and minor pairs, these exotic pairs are less liquid, more volatile, and come with very wide spread. Need to take that into account. So exotic pairs often include currencies from countries which are developing or less stable economies, and they may not be traded as frequently as major or minor pairs. Now, there are so many, by the way. The commonly known exotic currency pairs are, for example, USD TRY, you can see it is Turkish lira, USD Euro Turkish lira, USD South African rand ZAR, USD Thai baht, USD Mexican peso, USD Singaporean dollar, and so on and so forth. So with that in mind, what can I tell you for the beginners? Start with trading major currencies. As you can see, I've listed them here because they have high volatility, they have tighter spreads, especially for Euro and AUD, very tight spread, and the abundance of market information available online for you to start with. So as a trader, gain more experience and confidence, then you may understand, you may now try to trade minor and exotic pairs.